Okay, Chapter 10, Stockholders' Equity. Stockholders' equity is unique to corporations, and we're going to specify we're doing corporations so we know the accounts we're going to use. If we were doing LLCs or partnerships, we would have owner's capital accounts, an owner's contribution, and an owner's withdrawal account. But with stockholders' equity, the basic set of accounts will be common stock, additional paid-in capital, abbreviated as APIC, also called capital in excess of par, or a couple of variations on that, all means the same. I like additional paid-in capital because we can say APIC. It's a nicer abbreviation. Then retained earnings. In addition, there might be two other accounts we would use. Preferred stock, perhaps an associated APIC account for preferred stock. And treasury stock. The corporation form of business is chosen when the organization files with the Secretary of State the Articles of Incorporation. The Articles of Incorporation provide some information, the name of the corporation, what it's going to do, where it's headquartered, how many shares of stock they're authorized to issue. Whether the stock has a par value, or whether it's no par value.
What is par value?
It's an arbitrary amount that's ascribed to each share. In textbooks, for common stock, we usually see $1 par value. In real life, we see 1/10 of 1 penny as par value. It's essentially this day meaningless for anything other than journal entries. Back in the 30s and 40s, it had some meaning because if you didn't pay at least the par value to acquire the stock, if the company went bankrupt, you had to pay the difference between what you paid for the stock and its par value. If you set the price at 1/10 of a penny, you'll never pay less than par value, so it's not even an issue anymore. Authorized is the maximum number of shares a company is allowed to issue. If you're authorized to issue 1,000 shares, you can issue 1,000 shares. If you're authorized to issue 1 billion shares, you can issue 1 billion shares. Now, that's not the number of paper certificates. It's the number of shares. So let's say I formed a corporation that's authorized to issue 1,000 shares. I'll get, with the setup, blank stock certificates. I could make out each certificate for as many shares as I'd like. So I could take one piece of paper and in the corner write 1,000 and in the middle say this is 1,000 shares. So one piece of paper could represent 1,000 shares. It could represent 1 million shares, it could represent 1 share. Like if you're holding a piece of money, in the US, size doesn't tell you what it is, you have to see what's in the corner. Is it a 1? Is it a 5? Is it 10, a 20, or 100? Same thing with the shares. One piece of paper could represent any number. Now, for corporations that are traded on exchanges, if you buy stock, you generally don't even get the shares. Some broker will hold it in your name, and it's all electronic. Years ago, when I bought Disney stock, I wanted their certificate. Why? Because it was like a piece of art. It was multicolor, and they had all their characters on it. So a lot of people bought the stock, just got one share, framed it, and forgot about it. Today, you don't even get the shares, and if most of them probably are worthless as far as part goes. So let's say a company sells 1,000 shares of $1 par value stock, and they sell it for $5 a share. The entry we're going to make is to debit cash for the number of shares times the price per share. So that would be 1,000 shares times $5. They would credit common stock for the number of shares times the par value per share. So that would be the same 1,000 shares, but the par value is $1. And so they would credit the difference to additional paid-in capital common stock for 4,000. We also said stock could be no par value. So let's take the same situation, except instead of being $1 par value, it's no par stock. The debit to cash is still going to be the number of shares times the selling price. But in this case, we just credit common stock for the same number. So the only time you have additional paid-in capital is when you have a par value. There is one more situation. The company files its articles of incorporation. They tell the state, we want no par value stock. Now it's a month, 2 months, a year later, and they said, you know, we made a mistake. I really feel better about having a par value. Well, they're not going to go back and redo everything. So what they can do is adopt what's called a stated value. So the stock certificate is printed no par, but the board of directors adopts a stated value. And let's say the stated value they adopt is $1 per share. The entry to record the sale of 1,000 shares at $5 a share is debit cash 5,000, credit common stock 1,000, credit additional paid-in capital 4,000. So no par stated value works exactly the same accounting-wise as par value stock. If you want to learn managerial accounting, try to listen to both. Anybody ever had her?
Maybe she doesn't.
You want me to ask? sure? It's bothering you, I can. I'm guessing it's not gonna happen.
Professor?
Yeah.
The $1 is the cost for one share.
Not the cost. The $1 is the no par but stated value. In this case, it was par value. Now the corporation, when they incorporated, said it's no par value. But they decided they wish they had made par value stock. So they call it stated value. And the $1 is the stated value, the par they wish they had put on it. So it works the same as par value. Not the cost. The cost is always what they sell it for. In this case, $5.
And you get the 1,000. It's you multiply it by one.
To get the credit to common stock, it's always the number of shares times the par value or the stated value.
So the number of share 1,000. Yeah.
1,000. Same information. Sale price $5, stated value $1. You can also have preferred stock, generally not in small companies. Preferred stock is generally reserved for larger companies. What's preferred about preferred stock versus common stock? Now, I'm going to put a list of things on the board. These all don't have to be components of preferred stock, but this is a list the company chooses from in deciding what they're going to have in their preferred stock. They could have a set dividend percentage. The dividends could be cumulative. That means if it's not paid in 1 year, it has to be paid the next year along with next year before common gets dividends. So if you go 4 years without a dividend, preferred has to get the last 4 years dividends plus this year's dividend, and anything left can go to common. Can be participating, which means after their dividend is paid, whatever's left, they could still share in with common. What did they give up? There's only one thing preferred can't do. Vote. They get a preference in liquidation also. Ahead of common, not ahead of debt holders. Preferred stock works exactly the same as common, but the one difference is the par value is usually higher. So let's say we had preferred stock, $100 par with an 8% cumulative dividend. The reason the par value is higher is because the dividend each share is supposed to get every year is $8. We know that because we take the par value times the dividend rate gives us their annual dividend per share. If they had used a par value like common times 8%, their dividend would be 8 cents a year. How much would you pay for a dividend of 8 cents a year versus $8?
Zero.
Maybe more than zero, but not a whole lot. So they have a higher par value because the dividend percentage is going to be based on times it by the par. And if there's a par value and they sell it for more than par, there's going to be additional paid in capital, just like with common. So a company sells 1,000 shares of common stock. The common stock is $1 par value, and they sell it for $8 a share. They're going to debit cash, 8,000. Credit common stock, 1,000. Credit additional paid in capital common stock, 7,000. Now let's say the company goes out and repurchases, buys back in the open market 100 shares at $9 a share. Does anybody know what we call it when they buy back shares?
Treasury stock.
Treasury stock. So they're going to debit treasury stock for $900 and credit cash for $900. At this moment in time, let's say these are all the transactions that have happened to their stockholders' equity accounts. There are 3 levels of stock. The authorized, which is the maximum number that they can issue that's contained in their articles of incorporation. So just for argument's sake, let's say that was 10,000. The number issued is 1,000. Issued are the number of shares sold to the public. The outstanding are the number of shares still in the public's hands. How many shares is that?
Are you talking about, you said the maximum?
Is it 100?
What is that number on the top? Is that a maximum?
The maximum. That's just in the articles of incorporation, the most they're allowed to issue. Doesn't mean they have issued it. That's just the most they're legally allowed to.
So you issued 1,000. And you want to know how many are outstanding?
Correct.
So isn't it 9,000?
It's not 9,000.
It's not.
No. 900. The maximum is 10,000. The number sold to the public is 1,000. The number still in the public's hands is 900. It's the 1,000 minus the 100 we bought back. So outstanding is the difference between issued and treasury stock. We sold 1,000 to the public and we bought back 100. So the public still holds 900.
What's the difference between what and treasury stock?
It's the difference between issued and treasury stock. So let's say we sell 10 shares of the treasury stock for $10 a share. We're going to debit cash for 100. How much are we going to credit treasury stock for? Nope, the answer is 90. It's the number of shares times what we paid to acquire it. So whatever the price per share it went into treasury stock at is the price per share it's going to come out at. So if we bought it for $9 a share, when we sell it, we're going to credit treasury stock for $9 a share. And the difference goes to additional paid-in capital treasury stock.
We do that so we make it equal in the T account, or this way, the method that it is. Yeah, because the price in the market is 10, then you multiply it with 9, which is what we paid in the.
Well, the price we sell it for is the amount of cash we're going to get. The credit to treasury stock is the same price per share that it went into treasury stock. So that we always have treasury stock at $9. If this is the only transaction, it's all $9 a share. You can imagine, let's say the price went to $1,000 a share and we sold it, we'd have negative treasury stock. We debited cash credit to treasury, and that was more than the whole amount that was ever in treasury stock.
So as I said, so they make the balance in the T account, right?
Well, it's one T account, right? So we're going to have treasury stock. It's going to be 900. It's going to be 90. Now it's 810. It's the same T account. And this represents 90 shares times $9 a share. So now if we sell 30 shares of the treasury stock for $6 a share, we're going to debit cash for 180. How much are we going to credit treasury stock for?
270.
270. $30 shares times the $9 a share. Now we need a debit to balance. We need debit of $90. What are we going to debit?
I'm sorry. Here's how to follow. Is there a way we can go? So it says you bought back 100 at $9 a share.
100 at $9 a share.
So we go back to there and then go back again because I really don't know
Got it.
what happened
Here,
from there.
you're okay with this entry.
Well, you bought back at $9 a share. So
100 shares at $9 a share.
$9.
So now we have treasury stock. We're holding 100 of our own shares. And we decide to sell some of those. So we bought it back, and now we're going to resell it. Here we're selling 10 of them.
Well, from top, authorized issue, you're just explaining that it is. Treasury stock is the outstanding.
Treasury stock is the difference between the issued and the outstanding. So this
What
relates to this moment in time. We had sold 1,000, so that's the issued. We bought back 100, so now outstanding in the public hands are 900 shares. Now, this is no longer valid once we start doing this, because of the 100 we're holding, we've decided to sell some of them. Here we're selling 10 of them, and we're selling it for whatever the market price is. So the market price is now $10 a share. So that'll get us $100 cash. We'll credit treasury stock to reduce our treasury stock balance, but we'll reduce it at the price per share that we put it into treasury stock.
So, okay.
And the difference goes to additional paid-in capital treasury stock. Now we're selling 30 more shares,
For
$6 each.
apparently the value went down.
Market value went down. So that gets us $180, but we're still crediting treasury stock for the amount it went in at, so it's still at the $9 a share. So now we need a debit. The debit we want to do is additional paid-in capital treasury stock, but we can only debit it for the amount that's in additional paid-in capital treasury stock. How much is in additional paid-in capital treasury stock?
9.
No? We made T accounts for all these.
It's
We would
10.
do the T account for
10. It's 10.
it's 10.
10.
10 is correct. We can't debit it for more than the credit balance in the T account. We can make it 0, but we can't make it have a debit balance. So now we need $80. And when we used up the additional paid-in capital, the debit goes to retained earnings. Now, if we wanted to redo the little table of authorized, issued, and outstanding, the authorized still is 10,000. The issued is still 1,000. How much is the outstanding?
900. Oh, no. Uh, 60. 960.
960. 960?
Because you
No.
sold 40.
860.
You sold 40. You sold 10 and you sold 30.
So we bought back 100.
860.
It's confusing, doesn't it?
Okay.
You bought back 100.
How many shares of treasury stock do we now have?
140.
How many? Yeah. Think of treasury stock
Oh.
as pieces of paper that we have. We bought back 100. Of that 100, how many are we still
You sold
holding?
10, you sold 30, so like 60.
60.
Oh.
So if we have 60 shares of treasury stock, how many are outstanding?
940.
940.
40.
So how did that go up? I don't understand. I'm so confused.
Well, to get to here,
No, but if we sold it,
well, we have in our hands 100 shares of treasury stock. Whatever's in our hands is a subtraction from the 1,000. So we bought back 100. I have 100 pieces of treasury stock, which I'm subtracting. I've now reduced this. I've taken some of these and given them back to the public. So if this goes down, and this is a subtraction, the amount in the public hands goes up. Kind of hard to follow when you describe it like that. So just think of how many shares you have and subtract that from the 1,000. Okay. Dividends. Dividends are a way for a corporation to distribute earnings to the shareholders. Only the board of directors can declare a dividend. The board of directors will declare a dividend The day they do that is the date of declaration. As part of the declaration, they'll determine a date of record and a date of payment. So the date of declaration might be October 1st, 2015, and they would say with a date of record of 11/15 and the date of payment 12/26. Could be any dates. The date of record has to be after the date of declaration. And the date of record is important so you know who gets paid the dividend. If they just declare a $1 per share dividend and the stock is trading, people at different moments of every hour are going to be different who own it. Who gets the dividends?
The shareholders.
Well, which ones?
All system.
No, it's still common we're talking about.
Those that are on record.
That's why we need the date of record. Whoever owns the share when the market closes on 11/15 will receive the dividend. So this way, everybody has ample notice that the dividend is going to be paid to the person who owns it on 11/15. You don't want to sell the stock and then find out, oh, if you just held it an extra day, you would have got the dividend. You would have sold it a day later. So you need to specify who's going to get the dividend. That's the date of record. And when will they get the dividend? That's the date of payment. So whoever owns the stock on 11/15 when the market closes is getting a check sent to them on 12/26. Doesn't matter when they bought the stock and doesn't matter when they sold the stock. As long as they owned it when the market closed on 11/15. So in the last example, we had the maximum shares authorized were 10,000, issued was 1,000. And outstanding was 960, 940,
140.
940. Okay. So if the board of directors declared a $1 per share dividend on 10/1/15 with a date of record of 11/15 with a payment date of 12/26, on the date of declaration, what's the entry we would make?
Nothing.
Correct, but when the board of directors declares a dividend, it's a legal liability. So we would debit dividends and we would credit dividends payable.
Is this on the date of declaration?
Yes.
Okay.
How much do you,
$940.
how much do you,
How much, right? And 940 is correct.
$1 each.
We don't use the shares issued because Treasury stock does not get a dividend. It's only the outstanding. So if we have shares in Treasury, that doesn't get the dividend. So you're correct to say only use the outstanding. What's the entry on the date of record?
For the cash, dividend table.
That's no entry.
Nothing's paid, it's just that's the day it happened.
That's just the date at which you fix who's getting the check. The check doesn't go out until 12/26. 12/26, it's debit dividends payable, credit cash. Now, cash is just one form of dividend. How else could a company pay a dividend?
Stock.
They could do a stock dividend. They could declare a 10% stock dividend. So for every 10 shares you own, you get one more share. Or whatever you own, you'll have 10% more. So in this case, they would expect to issue 94 more shares. Or they could specify they'll issue 1 share for every 10 you own. It's the same thing as a 10% stock dividend, just phrased differently. Could they issue anything other than stock and cash as a dividend? The answer is yeah, they could get rid of some garbage inventory. Instead of throwing it out, they could mail it to the stockholders and say, this is your dividend. So they could issue property. Well, it would have to be something they have enough of to give everybody.
1,000 used desks.
There you go. A desk per share. Now, a lot of texts don't debit dividends. They debit retained earnings. But I hate to do that. Because when we do the statement of retained earnings, remember that it's beginning retained earnings plus net income minus dividends equals ending retained earnings. So I don't like to stick dividends in retained earnings. I like to give it its own account in the trial balance. So when I come to do this statement, I just look at that number and I put it here. If I, during the course of the year, debit dividends into the retained earnings account, I have to take that balance and break it out between the beginning balance and dividends, and then the other transactions that went through it. So this is a contra revenue account, and it will wind up as a reduction of retained earnings. I just like to show it in a separate account. I think it's easier that way. There can be multiple types of common stock. Traditionally, you see this in venture capital startups, where they go for different series of financing. The first series of common is common A. The second is common B. The third is common series C. What do you think the fourth one would be? Come on, say it. D. And they just keep going. Why did they need the different series? Because each series has a different set of rights. It could be more voting. It could be different payouts. It could be a lot of things. But the longer you wait to get in, the worse your terms are going to be. The best terms are for the early seeders. So the different series can have different voting rights. Some of them have super voting rights, where family companies want to sell to the public, but they want to keep control. So they might have 10 shares, they sell 1 billion shares, but each of their shares has so many voting rights associated with it, they'll always be the majority. It's not always 1 share, 1 vote, unless you only have 1 series. If all the common is the same, then it's 1 share, 1 vote. Between series, you have to be careful. So let's say we have common stock, 100,000 shares issued and outstanding. And preferred stock, 1,000 shares, $100 par value. %7 dividend cumulative. Unpaid for 2012, 2013, 2014. board declares a dividend in 2015 of $30,000. How much does common get?
$14.99.
How much?
9.
9?
You have to take out that for preferred.
The first, they get paid first for 3 years.
How many years?
One year's 4 years, then 615.
Correct. So how much is the preferred dividend each year? It's 1,000 shares times $100 par value is $100,000 times 7% is $7,000. They're owed for 2012, 2013, 2014, and they have to get 2015, so that's times 4. So preferred is going to get 28,000 of the 30. It leaves 2 for common. I'm just making this information up. This isn't any of the information we've used. So common stock, $1 par value, authorized 1,000 shares, issued and outstanding 500 shares. So common stock would have a value of $500. It's always going to be the number issued times the number of times the par value.
You said 500 was the total. $1 per value. Okay.
The dollar amount.
In preferred stock, I think about 100 shares authorized, 100 issued, and 100 outstanding.
They sold all of it, and it's all in the public's hands.
All that was issued, and now it's all, okay. I took that previously, I took the numbers to mean that this is how many are currently issued and how many currently outstanding. But you're saying that outstanding may fluctuate regardless of how many are issued.
Outstanding might fluctuate regardless of how many are
Because
issued.
they could have 100 authorized, only issued 70, and outstanding like 6 or something like that. So
Why would there be issued, the difference between issued and outstanding?
the ones that are outside, the ones that are still out there.
Where are the ones that aren't still out there?
The Treasury.
Exactly. So when you see the same number for issued and outstanding, what does that tell you?
They're all out there.
There's no treasury stock. And you could always issue up to the maximum, to the authorized.
As opposed to above the common stock, they've issued 500 and 500 outstanding. Does that mean there's 500 in treasury stock?
There's no treasury stock, but they have the ability to sell 500 more shares to the public.
Okay. They just haven't issued them all out.
Correct. You could have the same authorized and issued and a different outstanding. You could have all three the same. And in fact, a lot of people would say authorized, issued, and outstanding 100 shares. You don't have to specify authorized as 100, issued as 100, outstanding as 100. It could just be authorized, comma, issued, comma, and outstanding 100. But this tells you there's no treasury stock. And so we have common stock, number of shares times the par value, additional paid in capital, plus the preferred stock, number of shares times the par value, the additional paid in capital. The sum of these four is considered paid in capital. Then we add retained earnings to get total stockholders' equity. If we had treasury stock under retained earnings, we would put treasury stock and subtract it to get total stockholders' equity. On average, how much did the public pay to buy the common stock?
We're assuming that they paid for par value for it.
No, we're not assuming that.
Then you don't know how much they paid for it on average.
We do.
What?
1,100 divided by 2,500.
I don't think so.
Well, is the paid in capital?
Think of the entry we make when they sell stock. Debit cash, number of shares times the price they paid. Credit common stock, number of shares times the par value. And credit the difference to additional paid in capital. So when they sold common stock, they got 500 plus 10,000. They got 10,500 for selling 500 shares. So on average, they sold it for $21 a share. right? So if they sold 500 shares for $21 a share, we would debit cash 10,500, credit common stock 500, credit additional paid in capital common stock 10,000. That's how we would get those amounts. On average, what did they sell the preferred stock for?
I'm sorry, 240, what was that math before that? 500, 10,000, I say I get 21, but what were those numbers?
500 is the common stock. 10,000 is the additional paid in capital for common stock. That totals 10,500.
Yes.
500 is the number of shares they sold to get the 10,500. So the average per share must be 10,500 divided by 500. And we showed that by saying if they sold 500 shares at $21 a piece, they would have debited cash 10,500, credited common stock 500, credited additional paid in capital 10,000. Those amounts.
Right, I see that. 2,000 divided by 500, you get that. Just when you look at it, the way it's lined up, the way you wrote it, 500 plus 10,000 plus 10,500 plus 500. You know,
Gotcha.
So I was like, I couldn't see that it was divided, so.
Better?
Crazy math, yeah.
So preferred stock, we could do the same thing. 10,000 plus 100,000. 10,000 divided by how much?
10,000.
Divided by 100.
Why 100?
The number of shares they sold.
Oh.
I see you're confusing this 500 with this 500.
Yeah.
Now this is dollars, these are number of shares. It just so happened it's both 500 because it's $1 a share. This is $10,000, that's 100 shares. So that's dollars, that's shares.
Yeah. I see that.
Does everybody feel like they've sufficiently mastered stockholders' equity?
When you look at the question, the authorized is 100 and the outstanding is 100.
That means there's no treasury stock. They were allowed to sell 100 shares. They did, and the public still holds those 100 shares.
How am I gonna apply this to my everyday life? That's what I wanna know. I mean, buying stock is so much simpler, but I know if you're in the finance business, you'll have to use it, but I just.
This has nothing to do with buying, selling stock, investing, or finance. This is accounting. This is simply how the corporation records the sale of stock and the transactions related to it. I cannot tell you how this would ever matter in your everyday life. Except if you start your own business. You start your own business, you set up QuickBooks, you sell stock, you put in $100 of your money for 100 shares. Now you have to record it. You're gonna look back on this video to see how you're gonna debit cash, credit common stock, credit additional paid in capital.
This is difficult, but I don't know if I'm just. This is hard, right? Or no?
I can't really answer that. I mean, I'm sure your peers can tell you if you think this is difficult, you're probably like right in that sweet spot of where they are. For someone at, in my level of accounting, this is brought down to the easiest level you can give someone who's never going to be an accountant. Yeah. I mean, from the perspective of the accountant who does this,
Yeah.
there's a lot of stuff we're leaving out.
You don't have to like shorthand this anymore. Everything's like computerized, right? You don't have to do all this in accounting. Right?
The computer,
Helps you.
no, it really doesn't. I mean, I have a lot of clients, and some of them were startups, and they had a par value of, let's see, I'll erase some of this. The par value for the common was 0.0001 of a dollar. And they sold, let's say they sold 100,000 shares for $60,000. I'm making these numbers up, but to be honest with you, they're very close to the truth. So the question is, what's the journal entry? You still have to do the journal entry. Now, we all could figure out that we're going to debit cash, credit common stock, credit additional paid in capital common stock. That's going to be the basic entry of any stock transaction. But we still got to put the amounts in. So how much are we going to debit cash for?
60, bro.
60,000. How much are we going to credit common stock for?
$100.
It's definitely not going to be $100. Oh, well, maybe it will be $100. Hang on.
You drop off 302.
No,
$10.
$10.
Yes.
oh, $4.
Just cross out 30.
What times it? 0.0001 times
100,000.
times 100,000.
$10.
$10.
We're not-
Yeah, $10.
$10. So the credit to additional paid in capital is $59,990. And so you'll see that. You'll see entries where they're selling hundreds of thousands of dollars worth of stock, and the credit to common stock is next to nothing because of a very low par value. So do I take it you want to skip all the ratios? I should have skipped all this stuff before the evaluation. When I was in college, I met with a partner in a CPA firm. And he said accounting is pretty difficult. And it doesn't make a whole lot of sense. And he says, but one day you're going to get it. And all of a sudden everything will make sense. So, all right, I was waiting for this to happen. And at this moment, I don't remember where I was or what I was doing, but I do remember it happened. All of a sudden, I said, I got it. It makes sense.
How long did it take you? One trimester or more?
No, it took a couple of years. It's not going to be like the first year or the second year.
So
But
you were already a CPA with an app.
I was still a college student. My college career wasn't like most people's. I went to school for the 4 years, 8 semesters, and I graduated with my master's and my bachelor's on the same day.
That's nice.
Yeah.
Why not?
I like taking a lot of credits. I was an honor student, so I could take credits for free. And I got to register early. And this is before online stuff. We didn't have computers. So I got to go and run around with the earliest people. So I always got the classes I want. So I would take like 21 credits a semester. So the question was, what was I going to do? I didn't want to graduate early. I had a tuition scholarship and the summer job. So I wanted to be there 4 years. So I asked my advisor, I'm taking a lot of credits. Can we go to the graduate office and see if they'll admit me, even if I haven't finished my undergraduate degree? He said, why don't you just finish it? I said, because that ends my undergraduate scholarship. So why don't I leave 3 credits over so I keep the undergraduate scholarship while I'm doing really everything but 3 credits would be masters. So they said, yeah, no, we'll do that. That sounds really interesting. And you have to apply, you have to take the GMAT, you got to get recommendations, and we'll treat you like any graduate student, except that you don't have an undergraduate degree. So I took the GMATs, got the recommendations, did the application, then I got a full tuition graduate scholarship. So my undergraduate scholarship went from my living expenses. I got a check to pay my rent, and I paid for my meal plan. So my graduate degree and my undergraduate degree are dated on the same day. And junior year and senior year, I was also working 30 hours a week at an accounting firm. So I wanted practical experience. And so when I'm doing all of this stuff, I didn't do this in computer. We didn't have computers. I did this by hand. We used to have these green spreadsheets with all these columns and these little boxes. I forgot the name of the company, but it was a meat packing company. And once a year, they'd come in, usually around the end of January, with a shopping bag. And in the shopping bag are 12 unopened bank statements. And they gave me the shopping bag. I had opened the bank statements. And with these columns that really represented T accounts, put in every check, every deposit to make their chart of accounts. This became their general ledger, and make their financial statements so we could do the tax return. And learning by hand like that was the best experience I ever had. I learned everything that happens in a computer by hand. A lot of people just learn computers, and if something goes wrong, they can't figure out what happened because they didn't start with T accounts. The downside was, for like a month until I finished, my office smelled like bacon. And it was nice the first couple of minutes. You ever go on the beach and you get that coconut tanning, and it smells great for the first 15 minutes. By the 4th hour, you want to kill yourself? It was like that with the bacon. So I did everything by hand, learning from scratch. The other great thing, I don't know if you've ever seen a 10-key adding machine. That's the one with the tape. Mm-hmm. My desk had a right return. And so the adding machine was on the right, but on left. Ordinarily, you'd use your dominant hand. But I never used the adding machine, so I wasn't used to it. So I just started doing it with my right hand. Now I can only use my right hand, but I get to write with my left. So instead of using the 10 key and having to stop to write down what I just added, I could keep going. I was a master at this. So accounting, made sense for me, but that's all I ever wanted to do. Then the PhD came later.
So you're a savant, is what you're saying.
No, I just okay with accounting. Spent a lot of time with accounting.
You have that whole Da Vinci, both hands writing backwards thing.
No, somebody like Da Vinci is like nowhere near that.
He's not as good as you. Yeah.
No, my stuff, if he's Da Vinci doing all of this, then my stuff looks like a Pollock.
Okay.
Yeah. Definitely not a Da Vinci, but I love accounting. Spent a lot of time with it, and I don't like just to teach it. I don't think I'd ever want to be a teacher by itself, because I think it's important to always do it as you're teaching it. A lot of changes, a lot of things happen over time. And then if you're not doing it, all you know is when you went to school. And when I went to school, it's a whole different world. We didn't have computers when I was in school. Apple launched their first personal computer. IBM was a year or two behind. So the world is very different today, especially for students. PhD is a whole nother story. That came later. I thought it would be cool to be called doctor. A lot of people were getting CPAs and masters. I didn't feel so special. And I always thought, I was teaching, I was an adjunct at the time at Marist College. And I thought, you know, if I ever wanted to do this full time, if I had a PhD, it pretty makes it a lot easier. So it was an hour and 45 each way. So I went from Dutchess County, I went up to RPI. I don't know if anybody ever heard of it.
Yeah, my nephew went to school.
So, and the best thing that ever happened to me was they didn't have a part-time program. They said it's only full-time. You have to take 9 credits a semester. So that's 3 classes. 3 days a week I had to go there.
Was there like 2.5 hours? From there?
No, it was an hour 45 each way. You know, a little more in bad weather. So either I started at RPI and then went to work, or I started at work and went to RPI. And I set a goal that it should take 3 years, which was if everything went according to plan, I'd be done in 3 years. So I started in September and I ended 3 years in August. My actual plan was to end in June, but I didn't make it, but I still ended within the 3 years. There were people there that were in the program for 5 years when I started, that was still there when I left.
Why RPI?
Nah.
Why RPI?
Where I was, that was the best PhD program that I won't say reasonably could get to, but I could get to physically. It wasn't so easy or so reasonable. The big advantage I had was I had money. And so we didn't have computers, and you had 2 years of classes, and then you say it takes 1 to 2 years of just getting your research materials, because you had to go to the library and thumb through every journal to find every article you need for your thesis. And the rule of thumb was, when you've gotten every reference in every reference, you're done. So you get a reference, you look up their bibliography, their references, their citations, you get every one of those. When you get those, you get all of theirs. And when there's no more to get is when you stop. So I said, you know, I'm not going to the library. I think I went there once my whole time. So they had this index of accounting books. And I forgot how much it cost. It wasn't cheap, but I was the CFO, so I bought them. I thought it would be good to have, mostly for myself. I'll edit that one out. So each volume was for each year indexed 1,500 accounting journals by author, topic, and title. And I also had a full-time librarian where I worked. So I would get the papers, I would do the index, I would get the citations, I make photocopies and check off the ones I need. I give them to the librarian, she got them for me. It knocked 2 years off the thesis. You know, a lot of people couldn't buy these volumes, and they didn't have a full-time librarian. That made a big difference. And the other thing I did was, the director of the program said, and he had one of the people he co-taught with, he had to bring in her PhD thesis, 2 huge volumes. He said, this is the most magnificent work of research you will ever see, and you should have your head examined for doing it for your thesis. You never do your best research for your thesis. Your thesis is the least good you can do and graduate. What you want to do is get out of here, then do good stuff. But don't spend 5 years doing a thesis because you want it to be as good as possible. Make it as bad as possible. The least you can do and get done. And I took that to heart. So I did as least I can do. And here I am. So let's get to the homework. We had the first 9 exercises. Exercise 1. We have the following terms: publicly held corporation, organization chart, articles of incorporation, limited liability, initial public offering, double taxation, S corporation, limited liability company. Shareholders can lose no more than the amount they invest in the company. One of those terms. It is limited liability. Corporate earnings are taxed twice, at the corporate level and individual shareholder level.
Double taxation.
Correct. Double taxation. Like an S corporation, but there are no limitations on the number of owners as in an S corporation.
LLC.
LLC. Traces the line of authority within the corporation.
Organization chart.
Correct. Allows for legal treatment as a corporation, but tax treatment as a partnership.
S corp.
S corp. Has stock traded on an exchange such as the New York Stock Exchange. Publicly held corporation. The first time a corporation issues stock to the public.
IPO.
IPO, initial public offering. Describes the nature of the firm's business activities, the shares to be issued, the composition of the initial board of directors.
Articles of incorporation.
Correct. Your friend, Jonathan Fain, is an engineering major with an entrepreneurial spirit. He wants to start his own corporation and needs your accounting expertise. See, this is where you might have to know this. If you have that friend, Jonathan, and he came to you because he knew you took this course. He has no idea what the following terms mean. Authorized stock, issued stock, outstanding stock, preferred stock, and treasury stock. So what does each mean? Authorized stock.
Maximum.
The maximum number of shares you legally can sell. Issued stock.
Exactly what it means. Going to public.
The number of shares sold to the public. Outstanding stock.
You still have
Number of shares still in the public's hand. Preferred stock.
paid first.
It's a different class of stock from common with a different set of benefits. What can't preferred stock do? Vote. Treasury stock.
Stock you bought back.
Stock bought back in the public markets. Clothing Frontiers began operations on January 1st and engages in the following transactions during the year related to stockholders' equity. Issues 700 shares of common stock for $50 per share. Issues an additional 110 shares of common stock for $54 per share. Record the transactions assuming Clothing Frontiers has no par common stock. The entry on January 1st. 700 shares, $50 per share.
35,000.
Debit cash, 35,000. What do we credit?
Common stock.
Common stock, 35,000. April 1st, issues 110 additional shares of common stock for $54 per share. Debit cash, $59.40. Credit common stock, $59.40. Part 2, redo the transactions, assuming they have either $1 par value or $1 stated value common stock. So cash stays the same. How much do we credit common stock for?
700.
And the balance goes to additional paid-in capital common stock.
If you're using additional paid-in capital as the plug for the common stock, do you always denote common stock versus preferred stock on the additional paid-in capital account?
The only time you really need to have the hyphen common stock is when there's going to be when there's going to be more additional paid-in capital accounts. I've always gotten in the habit of doing it. Because sometimes when you're doing accounting, you don't know in the future whether they're going to issue or whether they're going to buy back Treasury stock or if they're going to issue preferred stock. In the context of the textbook and the exercise, you can see everything you need to deal with. You can see whether there's going to be Treasury stock, in which case we may have additional paid-in capital Treasury stock. So we do want to differentiate them.
Okay.
But in real life, you don't know what's going to happen in the future. I don't want to have to go back and start adding hyphen common stock. So I just always make it that specific right from the beginning. On a test, for this problem, if you left off hyphen common stock, it wouldn't be marked wrong. And how about for April 1st?
Cash 5940. Additional paid-in capital 5830. And common stock 110.
Any questions about 3? Exercise 4. Nathan's Athletic Apparel has 2,000 shares of 5% $100 par value preferred stock. The company issued at the beginning of 2017. All remaining shares are common stock. The company was not able to pay dividends in 2017, but plans to pay dividends of $22,000 in 2018. Assuming the preferred stock is cumulative, how much of the $22,000 dividend will be paid to preferred stockholders, and how much to common stockholders in 2018? Well, the preferred is 2,000 shares of $100 par value. So that's $200,000 worth of preferred. It's a 5% dividend. So the annual preferred dividend is $10,000. So preferred has to be paid $10,000 for 2017, $10,000 for 2018, or a total of $20,000. So how much is common going to get? Assuming the preferred stock is non-cumulative, how much of the $22,000 will be paid to preferred and how much to common?
Whether it be 10 and 12.
Common will get 20. Common will get 2,000 and preferred stockholders 20.
Well, that's what they get if it's cumulative.
It would be like 10 and
Okay,
12,
I got
because
you.
you get 10 per year. And then the remainder would go to common.
The preferred got 20 anyway, even though it's non-cumulative, there'd be no difference between cumulative and non-cumulative. Any questions about 4? 5. Italian Stallion has the following transactions during the year related to stockholders' equity. February 1st, issues 6,000 shares of no par common stock for $16 per share. So it's debit cash, 96. What are we going to credit? Common stock. May 15th, they issue 700 shares of $10 par value preferred stock for $13 a share. So debit cash, 9,100. What are we going to credit?
Preferred stock 9,100.
Preferred stock, but not 9,100.
Oh, it's you take the difference between additional paid-in capital for preferred stock. 2,100 to additional paid-in capital.
Yeah, but I like to do the preferred stock first, the number of shares times the par value.
Do you always record the number of shares first and then the difference in the second line of the entry on the credit side?
Well, so far you've gotten the right answers, so I'd say it doesn't matter. But generally, I think it's easier to get the preferred stock. This is the number of shares times the par value.
Right.
The difference is additional paid-in capital.
Got it. So the plug always would come second. I see.
Yeah, I mean, you could order it any way you want, as long as
Of course.
October 1st declares a cash dividend of $1.25 per share to all stockholders of record. So it's going to be debit dividends, credit dividends payable. But for how much?
Is it 83.75?
How do you get that?
Was all 6,000 of the common stock plus 700 of preferred.
Thousands of.
And then all that times, you have 5.
And you got
83.75.
83.75. Okay, October 15th, the date of record. What do we do?
Oh, that's the
No entry.
declarations.
Date of declarations today. And then 1031, debit dividends payable, 83.75, credit cash, 83.75. Any questions about 5? $10.6. Finishing Touches has 2 classes of stock authorized. 8% $10 par preferred, $1 par value common. The following transactions affect stockholders' equity during 2018, its first year of operations. Record each of these transactions. January 2nd, issue 100,000 shares of common stock for $35 per share. How much is the debit to cash? How much?
3,500,000.
3,500,000. How much is to credit the common stock?
100,000.
100,000. So that makes additional paid in capital common stock 3,000,004. February 6th, issues 3,000 shares of the 8% preferred for $11 per share. Debit cash 33,000. How much do we credit preferred stock for? 30,000. 10,000. 3,000 shares times $10 a share. September 10th, repurchases 11,000 shares of the common it sold for $40 per share. How much do we debit Treasury stock for? 440,000. And what do we credit? $9.15 reissues 5,500 shares of Treasury stock at $45 per share. So we're going to debit cash for how much?
247,500.
247,500, which is 5,500 times 45. How much are we going to credit Treasury stock for? This one you really don't need a calculator for. How much of the Treasury that we were holding did we sell, percentage-wise? Not all of it.
40.
Half of it, right? We bought back 11,000,
Oh, yeah.
then we sold 5,500. 220,000. Or 5,500 times $40 a share, or half of what it went in as. So what do we need? We need a credit for 27.5, not retained earnings, additional paid in capital Treasury stock. Retained earnings is what we would use when we need an extra debit.
Professor, in February 6th, it says issue 3,000 shares of 8% preferred.
Right?
What does the 8%?
That's the dividend rate on the preferred. But if you read the top section, 8% preferred has a $10 par value. So it's the $10 par value times the number of shares that gave us this.
So the 8% is that it's already written as a $10.
The 8% is just the dividend rate on the preferred. In where it says February 6th, they could have just said preferred stock. They didn't have to identify it as the 8. We only have one preferred. So they wanted you to take that preferred and look up to see what the par value. They want to restate the par value. I would have left off the 8% from there myself. It's not wrong the way they did it. Any questions about exercise 6? Exercise 7. Refer to the information in 10.6, its first year of operation. They have net income of $160,000. I'm almost sorry I erased it. And they pay dividends at the end of the year of $94,500 on common, $2,400 on preferred. Prepare the stockholders' equity section. All right, so let's go back to this. Exercise 6. They had issued, so we had cash, $3,500,000, common stock, $100,000, APIC common stock, $3,000,004. We had cash, $33,000, preferred stock, $30,000, APIC preferred stock, $3,000. We had Treasury stock, $440, cash, $440, cash, $247,500, Treasury stock, $220, APIC Treasury stock, $27,500. Okay. Stockholders' equity section. So we're going to start off with paid-in capital. Common stock has $1 par value. We know how many shares were authorized? We'll just say X shares authorized. How many shares were issued? 100,000 shares issued. How many shares are outstanding?
It's 100,000 common stock. It's 30,000 preferred.
No, we're just looking for how many shares of common are outstanding.
Oh, outstanding.
94,500 outstanding. And then APIC common stock, $3,000,004. We have preferred stock, $10 par value, X shares authorized, 700 shares issued and outstanding. That's 30,000. APIC preferred stock is 3,000. Total paid in capital. $3,533,000. is retained earnings. Retained earnings is going to be the beginning balance of 0 plus net income 160 minus dividends. How much we're
What's it? 96,900.
96,900.
Mm.
63.1. How much is Treasury stock? Close. This part would not be on one of your tests. We do have a balance of Treasury stock of 220,000. But we also have additional paid in capital of 27.5. So what are we going to do with the additional paid in capital on Treasury stock? I would just say, just subtract it from the 220. $192.5. So total stockholders' equity, I get 3,403,600. Any questions about 7? Exercise 8. Just 2 more to go. March 15th, American Eagle declares a quarterly cash dividend of 12.5 cents per share, payable on April 13th to all stockholders of record on March 30th. Record their declaration and payment of dividends on its $210 million shares. So the entry on March 15th is debit dividends.
Dividends or dividends payable?
Dividends. And credit dividends payable.
That's why I'm gonna get confused.
Between,
I figure out which one.
which is the liability? The one with payable in the title, right? And how do we increase the liability? By crediting it. How much are we gonna debit dividends and credit dividends payable for?
2,600,000.
So it's 210 million times point
0.125. Oh, 0.125. Sorry.
0.125.
262,500.
262,500.
500.
250. 1,250,000. Date of record is April 13th, no entry. No, date of record is March 30th, no entry. Then April 13th, debit dividends payable, 26,250. Credit cash, 26,250. Questions about 8? 9. Got to record each of these transactions. Power Drive Corporation designs and produces a line of golf equipment and golf apparel. They have 100,000 shares of stock outstanding at the beginning of 2018, and the following transactions affecting stockholders' equity in 2018. March 1st, issues 65,000 additional shares of $1 par value common stock to $62 a share. What are we going to debit? Debit cash for how much?
450. 4 million.
1,030,000.
4,030,000. And that's 65,000 times 62. What are we going to credit? For how much?
65.
Then we have additional paid-in capital common stock for how much?
3,965.
Okay. May 10th. Repurchases 6,000 shares of Treasury stock for $65 per share.
Do you have a treasury stock? $390.
Now, I will mention, don't even write this down, but for handling Treasury stock, there are 2 methods. We've been doing the cost method. The other method is the par value method. Par value method handles Treasury stock at par value. So just know there's 2 methods. Just know we're using the more common and the much easier one. June 1st. Declares a cash dividend of $2 per share to all stockholders of record on June 15th. Hint, dividends are not paid on Treasury stock. You didn't need the hint. So how much is the dividend? When the debit dividends, credit dividends, dividends payable, for how much?
118,000.
118,000. That does not sound right.
318.
Let's say there were 100,000 shares outstanding at the beginning of the year.
Oh, I'm sorry. I issued 65,000.
We issued 65, and we repurchased 6.
It was 60.
So is that 159 times $2 a share? 318 sound right?
Yeah.
Pays the cash dividend declared on, so July 1st, we pay the dividend. Dividend payable. Cash. And October 21st, reissues. First. Reissues 3,000 shares of the Treasury stock for $70 a share. So how much are we going to debit cash for? 210. How much are we going to credit Treasury stock for?
You do it at the value that you bought it back at, right?
Yeah, I think it's going to be 195.
Oh, you bought it at 65.
So we bought back 6,000. Now we're selling 3,000 of that. So it's going to be half of the amount of Treasury stock. So 195. So we'll need a credit to additional paid in capital Treasury stock, 15,000. Any questions on exercise 9? Okay, next week we have cash flow statements. Now that actually is helpful for users of financial statements, lenders, investors, board of directors. This has all been, up to this point, making the sausage. Next week, we get to do something that is also useful in making the financial statements, but exceptionally useful in using financial statements. So we're going to take a short break, and then I'm going to redo Chapter 9, long-term liabilities, so that we have the essence of what we'll need for the test on video for you and for the people that couldn't hear last week. I'm going to stop the tape, and I'm going to start it again. In the interim, anybody who doesn't want to stay doesn't have to. If you were in the room and heard it, solely up to you whether you want to stay. I promise you there'll be nothing